So, what if I told you that the speed of the whole AI revolution has, absolutely nothing to do with code?
Right. It's actually all about microscopic lasers.
Exactly. I mean, every time you generate a video or ask a massive language model to summarize a huge book, it feels like this infinite, frictionless software magic.
Oh, totally. It feels weightless,
Yeah, but today we're looking at the actual harsh physical speed limit of the internet, like the physical realities of hardware.
which is really where the actual bottleneck of this entire technological leap is happening. I mean, everyone is just so mesmerized by the consumer-facing applications, right?
Right.
The
Why
software.
are the prospectors in the gold rush?
Exactly. But the digital world is entirely constrained by the physical infrastructure that supports it. If you don't have the heavy-duty pipes and valves, nobody is mining any gold.
And that is the core mission for our analysis today. We're taking a stack of financial analyses, technical market data, and institutional research to really unpack Marvell Technology. The ticker is MRVL.
Yeah, we really need to look past the software layer here. We need to see if this company is truly the indispensable architect of the AI era, or just another tech stock caught up in this wildly overvalued hype cycle.
Because whether you're actively managing a portfolio and wondering if you missed the boat, or you're just fascinated by how the physical internet actually functions, you really need to understand who controls the flow of data.
I mean, the premise here is that you can write the most elegant, efficient software algorithm in human history, but
But it doesn't matter if the pipes are clogged.
exactly. If the physical infrastructure, like the literal cables and chips inside a massive data center, if they can't move the raw data between servers fast enough, the entire system just grinds to a halt. AI is fundamentally a data movement problem.
So let's start with the sheer scale of the financial inflection point we're seeing in the research, because Marvell is currently undergoing this massive structural shift in its business model.
Oh, it's a complete transformation.
Right. Their fourth quarter revenue for fiscal year 2026 hit $2.22 billion. That's a 22.1% year-over-year jump, which beat Wall Street estimates by a solid 7.5%.
And they beat on adjusted earnings per share, too.
Yeah, they did. But, the broader company metrics almost mask what's actually happening under the hood in their data center
Yeah,
segment.
for sure. The data center segment has entirely hijacked the narrative.
Yeah.
And honestly, rightfully so.
Yeah.
Yeah, I mean, that single segment just crossed the $6 billion mark in fiscal 2026 revenue. That is a 46% growth rate year over year.
That's insane.
It is. And to contextualize just how aggressive that growth is, management has actually been forced to raise their fiscal 2027 revenue guidance 3 separate times in just 6 months.
Wow. Wait, so what were they projecting initially?
Well, back in December, they were projecting around $10 billion for the upcoming year. Now they're guiding for approaching $11 billion.
And they're projecting even further out, too, right? I saw they formally introduced a long-term target of $15 billion in revenue for fiscal 2028, with earnings per share well over $5.
Yeah, those are massive numbers.
But, okay, as I was reading through their balance sheet and all the financial health data, I noticed something that initially looked like a huge contradiction.
The cash flow.
Yes. So they maintain a very manageable debt-to-EBITDA ratio of 1.38x. And just as a quick refresher for anyone listening, EBITDA is earnings before interest, taxes, depreciation, and amortization. It's basically a proxy for the raw cash profit the company generates from its core operations.
Right, it shows how healthy the core business is.
Exactly.
Yeah.
So a 1.38x ratio means their debt is very healthy
Yeah.
compared to their operating profit. But then I looked at their free cash flow.
And that is exactly where the numbers start to tell a much more complex story.
Precisely. Because in the third quarter of 2026, their free cash flow was $480.3 million. But in the fourth quarter, despite that massive revenue jump we just talked about and the raised guidance, that free cash flow plummeted to $259.4 million.
Right, it basically got cut in half.
Yeah. My immediate thought was a cash contraction of that size while revenue is supposedly booming. That's a glaring red flag.
It definitely looks like one at first glance.
But then digging into the balance sheet, I saw they had a record $374 million sequential inventory build. They are deliberately draining their cash to stockpile raw components, which pushes their total inventory to $1.39 billion.
Which completely reframes the entire financial picture. I mean, in
Yeah.
a vacuum, seeing cash flow drop is bearish. You naturally expect cash generation to scale linearly with revenue.
Right, you make more money, you have more cash.
Exactly.
Yeah.
But when you look at the broader semiconductor supply chain right now, this massive inventory build is actually a highly bullish signal. Management explicitly categorized this as, quote, working capital for growth.
Well, because in the semiconductor world, you can't just, snap your fingers and have chips appear.
Oh, not at all. The lead times, from ordering a custom silicon wafer to actually having a packaged, finished chip ready to ship that can stretch for many, many months.
It's a huge lag.
It is. The fabrication process is incredibly complex. So Marvell is looking at that $11 billion target for next year and that $15 billion target for 2028, and they're realizing that their biggest risk isn't a lack of customer demand.
It's a lack of supply.
Exactly. They're locking up foundry capacity and stockpiling physical components right now. If they chose to just preserve that cash on the balance sheet instead of buying inventory, they would literally run out of products to sell to the major tech companies next year.
Leaving, what, billions of dollars of guaranteed revenue just sitting on the table?
Precisely. It would be a disaster.
Which means this really aggressive cash burn is essentially a defensive maneuver to secure their future dominance. But, stockpiling $1 billion in inventory is a massive gamble unless you are absolutely certain your customers have nowhere else to go.
And that leads perfectly into the technological moat Marvell has built.
Right, because their entire value proposition right now relies on the actual physics of moving data, specifically transitioning away from electricity.
Yeah, the physical limitations of traditional data centers are fascinating. Historically, when you have two servers sitting in a rack next to each other, they communicate via electrical interconnects.
Meaning they just send electrical signals back and forth over copper wires.
Right. And for standard cloud computing, hosting a website, sending an email, copper is perfectly fine. It gets the job done.
But AI changes the math entirely. We're talking about clusters of tens of thousands of GPUs, graphics processing units, all trying to train a single massive language model simultaneously.
And when you try to push that much data at those speeds over copper wires, you literally hit the laws of physics.
Right, the resistance.
Exactly. Electrical signals suffer from resistance. Over distance, that resistance generates heat, and the electrical signal physically degrades.
So what happens? Do you just lose the data?
You either lose the data packet entirely, or you have to pump in so much power to push the signal through that the energy costs just become completely unsustainable. The heat alone would melt the components.
Wow. And this is where Marvell's dominance in optical technology completely changes the paradigm, right?
It does. They specialize in something called optical DSPs, digital signal processors, and 800G modules.
And just to clarify the jargon for a second, 800G means the module can transfer 800 gigabits of data per second.
Right. So instead of using electrical resistance over copper, these modules take the data, convert it into pulses of light, and literally shoot it through fiber optic cables using microscopic lasers.
Lasers, I love that.
It's basically sci-fi. But lasers don't suffer from the same electrical resistance. Light travels drastically faster over much longer distances, and it generates a fraction of the heat.
Which is why, in these massive AI clusters, optical interconnects aren't just a luxury upgrade. They are a fundamental requirement. You literally can't build the cluster without them.
Exactly. And Marvell holds a commanding market share in these 800G optical modules.
But the research makes a really crucial distinction here that I want to highlight. Marvell isn't just selling generic optical cables that anyone could manufacture, They are designing custom silicon.
Yes, that's the real moat.
And the biggest competitive advantage they've secured is their deep integration with Nvidia. Nvidia actually made a $2 billion strategic investment in Marvell, tying Marvell's custom chips directly into the NVLink Fusion ecosystem.
The implications of that integration really cannot be overstated. When a chip is natively interoperable with NVIDIA's architecture, it bypasses the need for complex software translation layers.
Meaning, if you buy a generic networking chip from someone else, the data has to be translated into a language NVIDIA's GPUs understand.
Right, which adds precious milliseconds of latency. And in AI training, milliseconds are everything.
But natively integrated hardware speaks the exact same language instantaneously.
Which creates an almost impenetrable switching cost for the customer.
Yeah, thinking about how deep those switching costs run, it kind of reminds me of the early days of the railroad industry.
Oh, how so?
Well, imagine you've laid thousands of miles of track across a continent at a specific gauge, like a specific width. If a competitor comes along years later and offers you a slightly cheaper train, but the wheels are a different width, it doesn't matter how cheap the train is.
Because it won't fit the tracks.
Exactly. You'd have to rip up the tracks across the entire continent just to use it. Marvell's technology is the track. Once a cloud provider builds a multi-billion-dollar AI data center around this custom integrated architecture, they cannot just swap Marvell out for a cheaper competitor without redesigning the entire facility from the ground up.
That is the exact dynamic playing out in the market right now. The intellectual property becomes foundational to the infrastructure itself.
It's lock-in.
Completely.
Yeah.
And this credibility in custom silicon is setting up what might be the most massive speculative catalyst in the entire sector. The research highlights these unconfirmed but highly persistent rumors that Alphabet, Google's parent company, is in advanced negotiations with Marvell.
Oh, right. The Google rumors and the specifics of that rumor are huge. They're supposedly co-developing a memory processing unit and a new TTU, or tensor processing unit.
Yeah, and Google designs these TPUs in-house specifically to rival Nvidia's processors for training AI models.
Right. And the historical context here is that Broadcom, which is another massive semiconductor company, has historically held a near monopoly on partnering with Google to manufacture these custom TPUs.
So if Marvell successfully finalizes this deal and actually displaces Broadcom, it sends a shockwave through the industry. It essentially proves Marvell can poach foundational, multi-year custom silicon contracts from the most entrenched competitors in the world.
So when you stack all of this up, you've got the optical physics, the Nvidia integration, and the looming Google partnership. It provides a very clear rationale for the explosive sentiment we are seeing in the market.
The momentum is wild right now.
It is. The stock is exhibiting extreme momentum. It's hovering around $172, which is up nearly 80% year to date.
And that momentum is aggressive enough that it has completely detached from historical analyst models. Like, the Wall Street consensus mean price target was sitting at 130.28.
Wow.
Yeah, so the stock is trading roughly 30% above what the average analyst model suggested it was worth.
And, whenever a stock blows past consensus targets that violently, it usually indicates that major institutional money is front-running the analyst revisions. The big funds aren't waiting for Wall Street to update their spreadsheets. They're already pricing in that $15 billion target for fiscal 2028.
And the filings prove it too.
They really do. The Vanguard Group increased its stake by 23.5%, scooping up over 15 million additional shares. Ameriprise Financial boosted their holdings by nearly 60%. The institutional accumulation is just massive.
And following that institutional flow is critical because funds of that size, they don't build those kinds of positions for short-term trades.
Yeah.
They are underwriting a multi-year thesis based entirely on the data center expansion.
However, looking at the insider trading data, I initially caught something that seemed entirely contradictory.
Oh, the executive sales?
Yes, while Vanguard is buying millions of shares, the internal executives have been selling. The data shows CEO Matthew Murphy sold $1 million worth of stock, and Executive Vice President Mark Casper sold $1.35 million in mid-April.
Right, which looks scary.
It does. If I'm managing my own portfolio, seeing the people running the company heading for the exits while the stock is at all-time highs feels like a definitive warning sign. But digging into the SEC filings, these trades were actually executed under Rule 10b5-1 trading plans specifically to cover tax withholding obligations.
And that context changes the narrative entirely. I mean, it's a common psychological trap for investors to see insider selling and just assume the worst.
Yeah, panic selling.
Exactly. But a 10b5-1 plan is a prearranged schedule established months or even years in advance. The executives lock in a mandate that says, sell this exact number of shares on this exact date, regardless of the current market price.
So it completely removes their ability to trade on non-public information.
Completely. And the tax obligation aspect makes it purely administrative. When these executives have their restricted stock units vest, it triggers a massive income tax liability.
Right, the IRS wants their cut.
Always. So the automated plan simply sells enough of those newly vested shares to pay the IRS. They aren't logging into a brokerage account and dumping their equity because they foresee a terrible earnings report. A pre-programmed algorithm is just paying their tax bill.
Which definitely neutralizes the bearish sentiment of the sale. However, just because the insider selling is benign doesn't mean the stock is without immense risk.
Oh, far from it.
Yeah. When a stock rallies 80% in a matter of months, it strips out all the margin of safety. We have to examine the bear case here because the market is currently pricing in absolute perfection.
And perfection is an incredibly fragile thing. to price into a stock.
It really is. Let's look closely at the valuation risk. If you are listening to this right now, looking at your portfolio today and considering initiating a position, you are staring at a stock trading at roughly 45 times forward normalized earnings.
Which is steep.
Very steep. Just to translate that metric for a second, it means you're paying $45 today for every $1 of operating profit the company is expected to generate over the next 12 months. And for context, Marvell's historical 5-year average is around 31 times forward earnings. You're paying a historically massive premium.
And that premium requires flawless execution. Every quarter has to be perfect.
Yeah.
And that vulnerability is really compounded by severe customer concentration risk.
Right.
The research notes that the vast majority of Marvell's data center revenue is reliant on just the top 4 U.S. hyperscalers.
And the hyperscalers being the massive cloud infrastructure giants, Amazon Web Services, Google Cloud, Microsoft Azure, and Meta.
Exactly. When your revenue is that concentrated among 4 massive clients, you lose pricing power. And worse, you become highly susceptible to their individual capital expenditure cycles.
So their spending dictates your revenue.
Entirely. The entire bull thesis assumes these 4 companies will continue spending tens of billions of dollars on AI infrastructure uninterrupted through 2028.
Which naturally raises the ultimate risk factor. What happens if macroeconomic conditions tighten? Or AI software monetization doesn't materialize as fast as expected, and just one of those 4 hyperscalers decides to delay building their next data center by, say, 6 months.
That is the Achilles heel of the 45x multiple. If Amazon or Microsoft pushes a major project from 2027 into 2028, Marvell's $15 billion revenue target suddenly looks unattainable.
And because the stock is priced for a perfect ramp-up, any hesitation or delay in order bookings could trigger a violent repricing downward.
The drop would be brutal. This places immense pressure on their upcoming May 27th earnings call. It's no longer just about beating the current quarter's estimates. The market needs sequential proof that the aggressive backlog they touted in March is actually translating into shipped products and locked-in revenue.
So if management comes out and shows any weakness in those future bookings, the momentum could break instantly.
Yes, the near-term volatility risk is exceptionally high. But, and this is important, the counter-argument, and the reason institutional money is willing to pay that 45x multiple today, is the concept of growth compressing multiples over time.
Okay, walk us through the math on that. How does paying 45 times earnings today eventually become a value play?
It all comes down to trusting the 2028 projections. If you underwrite the thesis that Marvell truly is the unavoidable bottleneck of AI infrastructure, and you believe they will hit that $15 billion revenue target and generate over $5 in earnings per share, the math shifts dramatically. So a stock trading at $172 today, eventually generating $5 in earnings down the line, leaves you with a forward price-to-earnings ratio in the high teens.
Oh, wow. So if you have the stomach to look past the current year and just ignore the inevitable supply chain hiccups over the next 24 months, you are essentially buying a high-growth tech monopoly at a very reasonable long-term price.
Exactly. The structural trend of data center expansion isn't going away. The path to get there will be incredibly volatile, but the destination remains fixed.
Which perfectly aligns with the final verdict from our stack of research today. Synthesizing the financial inflection, the optical technology moat, the Nvidia integration, and the stretched valuation, the analysis assigns Marvell an 8 out of 10 bullish score.
An 8 out of 10.
Yeah. It's framed emphatically as a multi-year hold through fiscal 2028, but heavily caveated by the need for investors to tolerate aggressive near-term volatility.
The volatility is just the admission price for participating in a foundational infrastructure build-out. There's no way around it.
And that is really the core takeaway from you as you process all this data. We constantly hear the term the cloud, which sounds, ethereal and weightless.
Like it's just floating up there.
Exactly. But the cloud is just a massive concrete building full of incredibly hot, incredibly power-hungry computers. And trillions of dollars of economic value currently hinge on the physical ability to push data between those computers at incomprehensible speeds.
It's all physical.
It is. Tracking the companies that manufacture the hardware constraints the microscopic lasers and the custom silicon. It tells you exactly where the future is heading before the software even arrives.
By watching the hardware, You are literally watching the blueprint of the digital future being drafted in real time.
Which leaves us with a truly fascinating and honestly slightly daunting final thought to consider. We've spent this entire deep dive discussing how custom silicon and optical lasers have become the most critical infrastructure on the planet. They're the new oil powering the AI economy.
Yeah, that's a good way to put it.
But if the physical ability to move data dictates the future of global technology, it makes you wonder about the inevitable geopolitical angle. As companies like Marvell and Nvidia become the absolute choke points for artificial intelligence, which is a technology that will likely define military and economic supremacy for the next century, how long until governments start viewing these companies not just as successful tech stocks, but as critical national security assets?
That's a huge question.
And when the invisible hand of the free market meets the heavy hand of global national security, what does that mean for their ability to operate freely? Just something to chew on the next time you marvel at an AI generating a perfectly written essay in 3 seconds?